This is Rod Kusin and Spooman for Risk on November 30th, 2009. In today's video, we're going to focus our attention once again on the MACD group reversal system. Now, our MACD group reversals are described on our website, RSKsys.com, in the first tab on the left. We recommend that you go there and study that so you understand more about what we're saying here. But basically what we have, we take an array of 6 different tick bar intervals. We run a MACD calculation on each of those 6, update that calculation intra-bar according to a formula, and combine the results. The results are combined in such a way that each of the 6 different tick bar intervals are color-coded so that we know at any one time how many out of 6 have a MACD trend that is in agreement. This little scheme shows us what the colors of each bar mean. Green means that 1 out of 6 has a positive MACD. Dark brown, or gold as it appears on the screen, means 6 out of 6 have a positive MACD, and anything there in between. So when you're looking at this move down, dark cyan to cyan to green and ultimately to gray, this shows a very nice simple decline in strength to a -6 and then back to a +1. That constitutes a group reversal, where we're now moving in the opposite direction and we're catching that move very precisely. Notice this is a 100 tick bar chart, and we only have 5 100 tick bars that have turned gray before we get our group reversal, which in this case is only 1/4 of a point, 1 tick away from the low. The market moves up, comes right back down, same price, same approach, green, gray, green. In this case, only 3 100 tick bars show up as being the group reversal. That's the low, that's the long. Market moves up again, comes back down, has a bit of a retracement right over here. And right here is where we see, again, the reversal. Now you can't get this precise using such things as Fibonacci. It's just not going to help you out that way. Not this precise. And notice how precise we're getting here. This little retracement comes down, cyan to green, and then back to gold, 1 tick off of the low of this move. Okay? 1 tick off the low. That's how precise this is. Now, on occasion, we get noise at the time of reversal. So let's go back here to, let's just look at this situation right in here. Let's suppose we were looking to go short instead of long. Where would we go short? Well, the raw or naked group reversals would show a short trade right here, followed by a long trade right here, another short trade here, another long trade here, another short trade here, another long trade here, another short trade here. We'd get whipsawed all over the place. What can we do to eliminate that? There are several possible filters that we can use. Now, Bollinger Bands could be used in some instances, and depending upon whether or not those bands were hit, or at least within a certain margin of error, they could filter out certain trades from taking place. We could remove long trades and only go short, or eliminate short trades and only go long. Bollinger Bands would be one way. Another method would be an adaptive price zone. But these have to be set very precisely. A third way is to use a detrended price oscillator and to create a zone around it. This is one of our preferred methods. Now, just to give you an example of what I mean. Now, here's just a typical DPO. We can set up, and this is very general, what I'm about to say. We could set up a zone that would say we cannot go short if the DPO is below the zero line. We can't go long if the DPO is above the zero line. That would be one way of doing it. So in this case, we could go long here, but we couldn't go short. And we could go short here, but we can't go long. And then we would eliminate a certain measure of whipsawing. That would be one way that we could do that. There's actually another way that we can apply, and that's by coordinating the MACD group reversals on the ES with the MACD of the tick and the VIX and even the premium. We can set up our system so that the trend of the MACD on the ES is also in agreement with several other data feeds. And that too will eliminate a measure of whipsawing. So there's lots of ways that we can do that. Because ideally, we don't always get such precise group reversals as we see on this chart. And when that happens, then we have to use some additional filters to identify more precisely where we're going to take a trade. Now let's just quickly take a look at the high of the move. Now we could look at various charts, but we'll just focus on one. Now this chart is showing us a progressive move upward to the point where we go from white to gold and then back to white. Here we have a group reversal, but as you can see, the group reversal is late. It is not as precise. It's not as precise as we would like it to be. The group reversal is happening right there. The high of the move, 96.50, 95 at the high here. It's a point and a half away from the high. Really? That's not a very precise move. It works, but it's not as precise, and unfortunately we don't have another chart that's any more precise than this. Not in as far as our group reversals are concerned. But we do have other things to help us. So very briefly, this chart at the same move that we just talked about is showing what we refer to as divergence. Now, I won't go into a lot of detail on this because I don't have time. But these yellow bars indicate divergence, and the horizontal bars refer to gaps. So we have a typical gap before divergence setup, where at the high of the move we see the divergence that's actually coming off of the VIX. So even though we don't have a reversal, we have divergence at the high to help us to see where to take the trade. This is just one of many ways that we analyze the market at risk. So we invite you to come take a demo, study our website, recognize what we're doing, and come join us at RSKsys.com, RSKsys.com. This is Rod Kusin and Spooman for Risk.